Welcome to the short executive knowledge lecture on topic 4, paper 8 of the SFC licensing exams. This topic covers types of securities, and as we'll see, there are many types that we will have to consider, and it's a mainstream topic at paper 8. You're going to see quite a few questions on this topic. I will emphasize the important points to help you understand the core material you need to know, sit the exam, and a copy of the study notes you see on the screen can be downloaded from the Executive Knowledge website under Paper 8 Resources. And as ever, I strongly recommend that you supplement this learning with question practice that is provided on Examinator.online. Just go to the Paper 8 practice questions. So topic 4, looking at the overview on the screen, equity securities. Now there's a lot of material on different aspects of equity securities. Then we'll consider margin financing. Good chance you'll have a question on margin financing. And then we go through a number of other topics all the way through to further discussion of stock options. Now I'd say right up front that some of the material is technically challenging. There are 40 questions at paper 8, and there may be a few that dig into the technical aspects that we are going to cover in topic 4. If you've studied this material before that, that's fine, and you should be in good shape. But what I'm saying is, if you have not, I wouldn't get tied up with trying to learn and remember all the technical material. Pick out the points that you are comfortable with and make sure that you score well on the exam. So we're going to start with equity securities. As it says right at the top, page 3, most common type of equity. These are the people who own the company. If you hold the equity securities, the ordinary shares, you will be owning part of the company. That takes us on to the ordinary shares, most common type. You will have voting rights and you receive a return in the form of dividends. That is, companies that are paying dividends on ordinary shares. Some, especially startups or growth companies, may hold back on the dividend. And on company liquidation, the ordinary shareholders entitled to get a share of the company, but after all other liabilities have settled. Now, something that's relatively new in Hong Kong is the concept of weighted voting right structures. And that is where it's often the founders of the company will get or will participate in a structure where they get more votes per share than the other ordinary shareholders. And this is to attract high growth companies, innovative companies to the market. A classic is Alibaba. Preference shares, receives the dividends rather that you receive are a fixed rate, a percentage on the face value. And in a liquidation, you will rank last apart from ordinary shareholders. So you'll be before ordinary shareholders, but after all other creditors. Bonus shares, we looked at bonus shares in topic 2, and those are issued to capitalize retained profits. Right shares, again, we looked at those in topic 2, and that is where new shares are issued to existing shareholders in proportion to the shares they already hold. Now, section 1.5 takes us on to stock options. Now, some of you may be very comfortable with this, others it may be new. Let's just look at the overriding concepts. An option is a right, not an obligation. It's a bit like buying an insurance policy. You have the right to claim in the appropriate circumstances and you pay a premium, but you don't have an obligation to claim. With options on stocks, you have the right to buy or sell at the exercise price. on or before the maturity date. Now, the Hong Kong exchange traded stock options are American style. What does that mean? It means that they can be exercised at any time up to and including the date of expiry. European style option can only be exercised on the expiry date. Key concepts of call and put options. A call option, that is the right to buy the underlying asset. A put option is the right to sell the underlying asset. Now, if you are buying the option, there will be somebody on the other side selling or writing the option. Now, if you take up your right to buy or sell, buy if it's a call option, sell if it's a put option, then you are said to be exercising the option. And as I've said, the seller or the writer of the option has the obligation to sell or buy when the option is exercised. So if somebody buys a call option and wants to exercise it, that gives them the right to buy the underlying security. Whoever sold the option must sell that underlying security at the exercise price to the party who is exercising the call option. Now, unlike futures and forwards, where the buyer has an obligation to reverse the trade, with options, there is no obligation to sell or buy. It will all depend on whether it's profitable to do so. When you are buying an option, similar to insurance policy that I referred to a moment ago, you will pay a premium. So when you buy an option, you're buying a premium. That is a premium for the right to buy or sell in the future. And examples of exchange traded options, there are options on shares, on indices, on futures. Now, it's worth just spending a bit of time on these calculations. What is a premium? How do we come to the option premium? Well, that is the value of the option. And the value of the option is the intrinsic value plus time value. Let's walk through a couple of examples to see how this operates. So a call option on the shares of Examinator.online has a strike price of $25. That means that if you buy the call option, you have the right to buy the underlying share at 25. If the call option is priced at $7.50 per option, what is the intrinsic and time values of the option if spot price is, right, $28 a share or $22 a share? Now, if it was $28 a share and the option gave you the right to buy at 25, strictly you could buy at 25 and sell at 28. So we say right at the start, the value of the option is $3. That is the intrinsic value, the money you would make if you exercise now, bought at 25 and sold at 28, you make $3. Now, with the call option being $7.50 and the intrinsic value being $3, then the time value is the difference, $4.50. Now, if the price in the market was $22 per share and you had the right to buy at 25, why would you buy at 25? You would go into the market and buy at 22. So there is no intrinsic value. The intrinsic value is zero. So if the option is trading at $7.50, then all that's left is the time value, that is $7.50. Now, the intrinsic value is the difference between the exercise and the market price at a point in time, as we've seen. But the time value reflects a value in the option where the future price of the underlying asset with a call option goes up. If it goes up, then you may well be in the money, or you are going to make more money when you exercise the option. So it's the opportunity of making more money over time. That's what we refer to as the time value. And as you get to expiry, the time value will reduce ultimately to zero. Let's look at a similar situation, but this time with regard to put option. Put option, the shares of Examinator.online has a strike price of $88. That means you can sell at $88. If the put option is priced at $28 $88.50 per option, what is the intrinsic and time values of the option if spot price is 68 and 100? Now it goes the other way. So if the price in the market is 68 and the option gives me the right to sell at 88, well, that's attractive. I go into the market, I buy at 68, and then I exercise my option and I sell at 88, making immediately $20 profit. So in this case, the intrinsic value is 20. As the option premium is 28.50, the difference between 28.50 and 20 must be the remaining time value, which is $8.50. If the share was trading at $100 per share, why on earth would I exercise a put option at 88, allowing me to sell at 88, when I could sell in the market at $100 a share? So again, the intrinsic value in that situation would be 0, and the whole option premium would be time value, in this case $28.50. So be aware of the concept of intrinsic value and time value, and the fact that the summation of the two gives us the value of the option premium. Top of page 6, we see that if the intrinsic value is 0, and we'd say you're out of the money, you're not going to exercise, whereas the intrinsic value is greater than 0, yes, you are going to exercise. And following on, we see that call option holders will benefit from upward price movement. Put option holders benefit from downward price movement, given that the exercise price is fixed. Now, the party with the risk is the option writer, the seller of the option, because you sell the option and you receive the premium. That's good news. But if the option you sold goes in the money, it is profitable for the buyer to exercise, then the seller of the option is going to lose money, and that can vary depending on the underlying stock price. Your upside, obviously, is the premium income, but you will have a particular view of the market such that the option is not going to be exercised. That is to say, third and fourth bullet points under the option writer, the call option writer expects the price of the underlying share to fall or remain steady. The put option writer expects the price of the underlying share to rise or remain steady, the opposite to what the buyer of an option would expect. As I said earlier, two styles, American style and European style, just notes on that. Now, the moneyness, call option, put option, the relationship between intrinsic value, moneyness, whether you're in the money, at the money, or out of the money, easier to see that with diagrams, and we're just going to move on to that in a moment. Option premium, just repeating ourselves, value of, or price of an option, and it is intrinsic plus time value. Now, here are the diagrams for options. Now, when you're looking at these diagrams, if the horizontal line is on the left, then you're dealing with calls. If the horizontal line is on the right, you're dealing with puts. Now, if we look at calls, if the horizontal line is below the x-axis, it's what we say a long call. Somebody's buying because they are having to pay the premium. Whereas with the short call, somebody selling the call, they will receive the premium so that they will be profitable. They will be holding, in this case, the premium of 5. Now, in both cases, the strike price of the call option is 50. Now, as the price increases, if we look at the top diagram on page 7, as the price increases and goes beyond 50, somebody holding the call will make money if they exercise. By exercising the call, they will buy at 50 and they will sell at above 50. So in exercising, they will make money. Now you can see that if the price rises to $55, we say we break even. That is, we've paid the premium of 5, we've made a profit, we sold at 50. I beg your pardon, we bought at 50, we sold at 55. And so the two cancel out. you break even when the stock price is at 55. If it goes beyond 55, you will have made money. Now, for the long call, for the person who's bought the call will be in the money if the price is beyond the strike price. If the stock price is less than the strike price to the left, then the call will be out of the money. And if the price is bang on the strike price, 50, then it is known as at the money. And that is the relationship for call and for put options. Put options, it is the other way around. And if we look at the long put diagram, you will see that you pay the premium of 5. You're only going to make money when the price falls. So if the price goes below 50, you can go into the market, buy it below 50, and then sell at 50 and make money. And again, you will see that when the price falls by 5 to 45, you will recover the premium. You have broken even. Once it goes below 45, you will be making money. Again, the put option will be in the money if the stock price is to the left of the strike price. It will be out of the money if the stock price is to the right of the strike price, and if the stock price is the same as the strike price, then it is known as at the money. Now, the short call and the short put are mirror images of the long call and the long put, because the person is receiving the premium in both cases, and then as the price rises with the call, falls with the put, the buyer will exercise, and if it goes beyond break even, then the writer, the seller of the short call and the short put, will be losing money. Now, it's a lot easier to visualize those diagrams when you are considering option questions, if they give you numbers, and it's well worth practicing just scribbling out a diagram when you're doing a question and working out where you are on the x-axis and how much money is being lost or made.